Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you the widget on Wall Street? You know, like the wolf on Wall Street, but the widget on Wall Street. Only here, you're actually the lamb. Wall Street's still the wolf, and you're the lamb for slaughter. So I ask you again, are you just a piece of their lie chart, aka pie chart? Pie charts are us. Ooh, did I say that out loud? Lie charts? You see, you're the diversifier. They're taking your money and they're spreading it out amongst all their clients. The pie charts are us. What's in the pie charts are us? Emerging markets, international, China, corporate America, large cap, small cap, investment grade bonds, muni bonds, corporate bonds, government bonds. Oh my. You are the input, the financing to fund their pet projects. They just made your money, their money, and they charge you a fee for it. So they're spreading their money out to their clients, making a bunch of money in fees. That's where they're making their big money, but they're still charging you a little fee to make money. That kind of seems like double dipping to me. Anyway, so you thought you were the client? Really? Really? You're the lamb. You're the cattle, the chattel, the property. They own you for their purposes, the diversifier, the input, the widget. For their pie charts or us portfolios, lifestyles funds, target date funds, 60-40, asset allocation with rebalancing. It's just another piece of their sell side portfolio. So is your advice compromised? Is it just propaganda and sales literature, just disguised as advice with just enough compliance, wrapped in just enough compliance? God, I love that. Folks, we're going to show you a better way to invest. We show you every day. We pull it back, we pull out, we open the hood and show you how we manage our money, and we can make your money look exactly like our money, like Don and I's money. The principles of this firm are in it knee deep. All of our money is in these portfolios. So when that guy at CNBC says, this stock, I don't own it, my wife doesn't own it, company doesn't own it, but you should. You're the diversifier. You're the product. Whenever he tells you he doesn't own it, that means there's a conflict. He's lying. End of story. All right. I'm going to go to the mailbag because it sets this up perfectly. And by the way, we did have some show notes, some of the articles in the show notes. Could Trump's tariffs fund a U.S. sovereign wealth fund? That's one article. Pretty good. Super catch-up contributions are here, but with limits. So if you're between 60 to 63, you got a 2-year window where you can stuff in an extra $3 or $4 grand over the additional catch-up. The great crypto crash, that's going to be, we're going to talk about that in a minute. Schwab expands 24 hours to retail and clients, and bill to eliminate taxes on Social Security is in the House. Now, so all of those are in the mailbag. You can go read that. But one of the articles was sent to me on 213 by MB. He's a client and a listener. And the article is The Great Crypto Crash. I think it was by The Atlantic. And it's talking about, Trump's tariffs and stuff or the crypto stuff that Trump's doing could cause troubles. So he says, if the experts I spoke with did not counter the narrative, but if that happens, the U.S. and the world should count themselves lucky. The danger is not just crypto-friendly regulation will expose millions of Americans to scams and volatility, but it will foster opacity. I don't have to like opaqueness, but opacity. Opacity. Thank you, Don. God, I knew I asked you on the show for something. Don's our resident grammar expert. My grandmother's passed away, so I got to ask Don. Making it harder for investors to determine the riskiness and to assign financial product, meaning they're going to be able to lever up and they're going to do all these crypto products. Beware. What's new? All right. Crypto would become more widespread, wilder, less transparent, more unpredictable, trillion-dollar consequences extending years. So basically you're saying, look, with all these crypto stuff, it's good. They're going to lever up and they're going to, like they did in 2008 and try to, get too leverage and blow up the system. Absolutely possible, just like the tulip craze, to the roaring 2000s, to the internet bubble, and now possibly even AI and crypto. Bring it on, because that's exactly how Revere makes money, using a sell discipline and buy and sell rules. We have money in Bitcoin in the past, but we have a sell, and maybe even now, Don will tell you, and have a sell discipline, but we will not ride prices down. We love bubbles that the empire, the evil empire that is the Fed, the chairman and now chairwoman, like Bubbles Greenspan, Helicopter Ben. We need names for Yellen and Powell. I've got, I can't think of one for Yellen. I got print him up Powell, although he's actually been not as dovish as I thought. I guess that inflation is still a little sticky. Anyway, I said, but this article is a Wall Street article for Pie Charts or Us Buy and Hope Investors. It simply states crypto adds risk and leverage. I agree. But how do you participate while rising and avoid while declining? The question is not, is crypto dangerous? Of course it is. Every asset in your portfolio is dangerous. How can I participate in bubbles that can last for years? 97, 98, 99 through March of 2000? That was 4 years it was too high. But if you missed out, you missed hundreds of percent, like in the 20s, right? So in Don's Gold Nugget, more gains have been lost trying to avoid the next bear market than the next bear market itself. Folks, feelings don't help you. They hinder you trying to invest. Just because you feel the market's high, right now the market's poised, looks like it wants to rip snort higher. We'll talk about that. Okay. And then, so here they're talking about people are selling because they're scared. So they're offensively selling, but with no rules. They're just doing it because they're feelings. And it says, then continue higher. Many people who jumped out, well, now I'm talking about people like behavioral finance now. People will actually sell because they think it's too high. They're scared because they hear the news. They're managing to the headlines, right? And now the market continues to go up and they see these 20, 30, 40, and finally they go, oh my God, and they get back in. And they jumped out due to fear, not metrics, and then they jumped back in because they said uncle and got creamed. Does that ever happen to you? That's why you need a strategy based on rules. It's way better. Price equals truth, no exceptions. Now, this is a good article for selling fear, and all sarcasm aside, MB. I agree with this article about the leverage and that it is murky. But you're making my point. That's why you need a sell discipline. That's exactly right. Listen, this is great stuff. Look, we will never hit the top, and occasionally when we're offensively selling because the stock went up too much and we sell a piece of it, you always leave a run. Then maybe we'll get lucky just out of law of large numbers. We'll never hit the bottom because we don't try to dime the bottom. We don't try to buy the bottom. It's got to come up on some volume. So we're never going to do that. Okay. Don's going to explain how we manage the trends, but we do not buy and hope. Every stock must earn its way onto our portfolio and continue to earn its way onto our portfolio. So what's in your portfolio? Okay. So rather than selling, Wall Street gives you a pie chart, a lie chart, and tells you that diversification is your protection. Diversification will not protect you in a bear market. You need to sell or hedge. And that is what Revere does. So with that, Don, I want to go to the team and find out what the market is telling us. Are we getting defensive and hedging and moving to cash? Or are we staying in for the moment? What's the market tea leaves tell us?
Well, we're always adjusting our exposure based on what the market is doing. We know we're not going to be right. We know, in fact, we know we're going to be wrong on half of the stocks that we buy, which is why we keep our stops tight, never lose big in any individual name. The ones that work, we let them continue to run. But you said I'm going to explain how we manage our trends, and every night in the videos we present this trend gauge. And basically, there's four major things that we're looking at. The first thing is the overall indexes, because the M in the O'Neill-Cancelin methodology stands for market. If the market is in your favor, you want to be in the market. If the market is not at your favor, you want to be out of the market. It's really that simple. If it's going sideways, you wait for it to resolve one way or the other while you don't press the gas down. So we take that to the next level and look at it over 3 time frames. The short-term time frame, which is the 21-day moving average, the green line on all of our charts. The medium-term 50-day moving average, that's the red line on all of our charts. And the long-term 200-day moving average, that's the black line on all of our charts. We've studied bear markets, taken a deep dive into them, and the market never gets into serious trouble unless you break below this black line. That's the 200-day moving average. Every single bear market in history takes place below this line. So if you're above that line, you can take the fear of a bear market as defined by a 20% drawdown in the S&P 500. You can take that off the table. We also monitor if we start to break the 50-day moving average. We also monitor the 100-day and the 150-day kind of as guideposts on the way down to the black line, the 200-day. And what you frequently find is that the market finds support at the 20-week or 100-day moving average from an index standpoint and then resumes its uptrend. So once we have the market in our favor, we then look at leading stocks. What sectors are acting well? What fundamentally sound stocks we're looking for growth stocks. They need to be growing their sales and their earnings to varying degrees. It's something that's growing sales and earnings at low single digits is not something that we find particularly attractive unless looking forward there's going to be a big jump in their sales and earnings based on a new product or a new business segment or new market conditions that come out. So we're always looking for that. But so we invest across the time frames on the indexes, and then we look at the market leaders. And what we want to see is 4 green arrows, which is what we have right now. Now, there are a couple of weaknesses. Mid caps are below their short-term 21-day. Mid and small are below their 50-day. But other than that, the market conditions are fine and leaders are acting well. We detail it every night in our videos, what we do, and we dive a little bit deeper in these podcasts once a week, talking about various themes or educational segments. And we're completely transparent, talking about the changes that we make to our portfolios, why we're making them, and we present keys entering each day and what we're looking for, the keys for the next market day. That would, if those keys change, then we're going to change our stance. That's basically how we make the decision as to whether we're going to get more bullish or less bullish. And it goes by what the market is telling us. These keys, we break levels. Go ahead.
So I want to, so folks, think about it. Think about how you feel emotionally right now about the market. It feels a little scary. You know, the headlines are going, the tariffs, all that stuff. But if you look at it unemotionally with just facts, Don's showing you those 3 green arrows. All 3 short-term, mid-term, long-term momentum is all up, meaning the market is showing us right now it moves higher, and that is counterintuitive. So I just wanted, and by the way, when Don's talking about this, these guys have a phone call every morning for 45, going over all their stocks, all their an hour before the market opens, and they've already figured out a whole game plan for the day. Is your advisor? So we got 6 people looking at these portfolios before the market's even open. Is that what your advisor's doing, or you got a lie chart and he's asking you for a tea time? Go ahead, Don.
So you're right, Dan. There's been a lot of headlines, and primarily they've been based on what's going on with inflation and tariffs. Those have been the 2 main focal points. And then you got the Fed and how what their outlook is. Are they going to keep interest rates steady, or are they going to cut them, or are they going to raise them if inflation gets out of control? Well, we've seen 2 things this week and last week. Let me go to a 60-minute chart here. And basically, all that's going on in the market is a little more than a 3% range over the last, it's been 4 weeks now, 20 trading days. We've tested the lower end of this line. We broke below it and got back above it. But every time we get up near, and today we got within a point of all-time highs on the S&P 500, and we pulled back a little bit since then. So you can see the waves and how these would deal with somebody's emotions if you weren't looking under the head like a technician about at what's actually happening to individual sectors, what's happening to the dollar, what's happening to interest rates, and how is that uh, carrying over to the individual names. If over the last 4 weeks you got in at the top, you just lost money. You just watched it evaporate. Um, which is, as long as you keep the losses small, that's fine. But we've been talking for weeks in here that we want to focus on low risk entry points. Now, contrary to what we're seeing with the indexes here, we've seen a bunch of growth names gap up and continue to maintain their strength. And we've played several of those. We've highlighted them in the nightly videos, and we continue to have positions in them. We've got stops in all of them in case they decide that they're not going to work and they're going to U-turn. We get stopped out all the time, and we talk about what we get stopped out about on the videos as well. So this is emotion on parade right here on the S&P 500. And something else that we track very closely is sentiment. And we saw something extremely interesting this week. And we track AAII sentiment. This is, I'm going to bring this into the screen here. This is what retail investors do. And it is a contrarian indicator. In other words, when they're extremely bearish, the market tends to go up. When they're extremely bullish, the market tends to pull back. And retail investors are ruled by emotion, plain and simple. They are casual market. Maybe they get a newsletter, they buy and sell here. But this is why a lot of the buy and hold pie chart people say you can't do this yourself, because you let your emotions into it. You don't have a solid system that is mathematically proven to produce a profit over the long term. So what we saw going back each of the last 3 weeks, I just showed you the gyrations in the market on a weekly basis, but bulls have pulled back each of the last 3 weeks, and now to where they're only 28% of retail investors are bullish and 47% of retail investors are bearish. That's a 1-year high on bearishness, 47.3%. Does it make sense that we should be that bearish when we're at the top of a range, 1 point from an all-time high on the S&P 500? Absolutely not. And that gets back to the point that you're making, Dan. The headlines, and let's not kid ourselves, the news does not like Trump. They don't like anything that he's doing because they're left-wing news organizations. So they're going to make him sound bad on every turn, every opportunity that they get. The retail investor listens to this. Even watching CNBC, they have a very strong leftist slant. They have a couple of hardcore Republicans on there, but they're not politically neutral. If you saw Andrew Ross Sorkin crying when Bill Ackman was on there before the election, you know what I'm talking about.
Yeah.
So where does this bring us into in our approach? And it's we do everything we can to take emotion out of it and just go by price. And that's what the point that we try to drive home in every video, every night, by showing what we're doing, showing the return of our flagship portfolio, showing the trades that we're doing, showing the inter-asset correlation that is extremely important to what's going on. And the bottom line is that despite what the retail investor is showing here, the market is set up for higher prices. We had something potentially, let's go back to the daily chart here, and every one of these long candles was, over the last 2 weeks, was in one way or another impacted by tariff talk, tariffs in the headlines. Even going back to last Friday, a week ago at 11 o'clock, we had a hard reversal because there was tariff talk that came out. The expectation on Monday morning was that we were going to gap down, which is what we had done each of the prior 2 Monday mornings based on, again, tariff talk. Well, we bucked that trend. We opened higher and we held it. We held it for Monday. We held it for Tuesday. Then on Wednesday, CPI came out. And Dan, I was talking to you pre-market on this. I said, I don't like this. The CPI number was hot. The expectation is that it's going to be a weight on the market. And I couldn't have been any more wrong. We
Mhm.
put in the low within the first 5 minutes that
Yep.
day and
Yep.
climbed higher, despite the fact that inflation data came in hotter than possible. That tells me that there's underneath the surface, the institutions. First of all, money will flow to where it's treated best. The U.S. is setting up with limited regulations, cutting the debt. It's setting up the environment to be conducive for businesses to be able to grow. And then yesterday, for the first time, tariff talk came out. The market was pulling back. Trump was having a press conference, but he pulled something new out of his bag of tricks, and he said we're going to have reciprocal tariffs, and we're not going to implement them until after we do a deep study by the end of the first quarter, and they're going to be reciprocal. In other words, if you charge us 12% tariff on our exports, we're going to charge you 12% on imports for the similar widget. And this gives business leaders some clarity. They can plan, okay, we produce this product. They tax us over in Europe 15%. We need this raw material. The corresponding tariff is going to be the same as what they're charging, we're going to charge. It allows them to plan instead of the nebulous tariff talk that we've seen, including the punitive tariffs that were threatened on Canada and Mexico because of fentanyl. I mean, that was over in 2 days because Trump got what he wanted. He threatened them with tariffs. They said, okay, we'll bring troops to the border to cut off the flow. And the market recovered. And it recovered yesterday. And in fact, it broke above very short-term resistance and made a higher high after that reciprocal tariff comment came out, because it was two things. One, it delayed them, like I mentioned, until the study's complete. So they're going to know what every tariff on every product is, and we're just going to reciprocate with the same amount. So the market seemed to like that, and it's trading in a tight range today, not giving those gains back. So we're hanging right near the top of this. If you're a bull, you want to see we're trading at 61.18 right now, a little after noon on Friday. If you're a bull, we had been talking in our videos about the 6,000 to 6,100 level. We broke above 6,100. We want to hold that on any pullback and then break above the 6,128 level for higher highs. It's really that simple. It's level to level that won't change any of our keys that we put out. In fact, it'll just make us look for higher targets and change what was resistance at the 6,100 level to be support. When resistance flips to support, that's extremely bullish because it puts a floor under the market. And now if 2 weeks from now we break below 6,100, well, that's a change in our expectation. That's a change to one of our keys, and we'll take defensive action.
Yep.
So it's the same process repeated day after day. Our videos have the same format. We focus on leading stocks. We focus on sectors. We focus on inter-asset correlation. And most of all, we focus on education and transparency, because that's very much lacking. And it's why Wall Street has a bad reputation, which we agree with. We'll point it out. We've talked about it ad nauseum about the bad taste in our mouth we have about some of the things on Wall Street, but
Absolutely.
that's where we are today.
Yeah, absolutely. And folks, listen. So Wall Street, it represents the sell side. They're conflicts of interest. And look, with the politicians, I don't care if you're on the left or the right. They're all a bunch of liars. I don't trust either side of them. But so it doesn't matter what the policies are. We've got to manage your money and our money according to what the policies are, based on price. So that's what we're going to do that. But if you saw that chart Don just had up, you noticed that all the moving averages were stacking nicely in order, and the second derivative, the rate of change of the slope of the line, the ROC of the line, is hooking upward. See, he's put it back up there. See those lines hooking up there? They're all stacked, and that is bullish. That's saying the market wants to move higher regardless of whether you're scared. I'm scared, but that's how I get out of my own way. All right, Don.
Yeah, everything we do is to combat these emotions, because I'm a naturally conservative person. The first trade I ever put on, I lost $20 and I broke out in a cold sweat. This was 25 years ago. I didn't know what I was doing. I was a retail trader, and I had no system. luckily, I got lucky and made money during the internet bubble, and then I gave it all back. That led me to find the William O'Neill methodology.
What a
and
difference a
we've built
quarter
our
century makes, Don. What a difference a
no
quarter
kidding.
century. All
We've
right, let's go to
built,
the team.
we've built this business on it, Dan. This
Yep.
is, and the more people hear about it, the more they're like, wait a minute, you're saying I can get market returns or better and not have to worry about losing maybe more than 8 to 10% to the downside? That sounds pretty good to me. We talked about our MAR ratio. That is a ratio of what your average compounded annual gain is divided by your biggest drawdown. Ours is about a 1. Our biggest
Pretty high,
drawdown
yeah.
is close to in line with our annual return. If you look at pie chart advisors, theirs is closer to a 0.25 because they'll gain 8% a year, but they'll have a 50% drawdown or 40% drawdown if they're diversified. Oh boy, only a 40% drawdown because I was diversified.
Yeah,
And those are the actual numbers that happened in 2000, 2007, 2008, and they will happen again. It's just a matter of when. There was a big bear market in 2022, and our drawdown was 13%, while the market lost 28% at the bottom.
Here's what Don's telling you, folks. We manage our own money exactly like this. If you want your money managed like that, we're buying the exact same stock at the exact same price and timestamp in the exact same percentage. For my mom, my wife, me, Don's wife, our kids, the family, everybody. They're in one of our, all of my money is in one of our Revere portfolios. Same with Don. So when that guy in CNBC says, this is the greatest stock since sliced bread, I don't own it, my wife doesn't own it, our company doesn't own it, you should. That's a conflict of interest. He's saying that because he has to. The company that he's touting is their client. When I tout a stock, we own it. I mean, if I say you should buy it, we're buying it. We're buying it for us and you. There are no conflicts of interest ever. We don't do big commission annuities with no surrender penalties ever. If you want a better way, come to Revere. Go ahead, Don. Let's see what the team's got.
Yeah, well, first, if anybody wonders how we do this when Dan says the exact same price, there's something called a block trade. And basically, we have over 700 accounts at Revere. And if we decide we want to buy 5% of Apple, we just calculate what 5% of our total asset under management would be. We would buy 5%, and then the software breaks it up depending on the size of your account. You get the correct number of shares. So everybody gets the exact same price. It's just the number of shares that you get that varies depended on.
Yeah, it's based on the portfolio.
We're not a mutual. We're not a mutual fund. We're not a hedge fund. We're a registered investment advisor that manages separate accounts. Everybody gets a separate account. They can log in and look at it 24/7. They can see the trades being posted to their account, and that's how block trades work. Yeah, all right, enough talking for me and Dan. Let's get on to the team, and let's start off with Connor. He's going to take a look at some gap stocks and an ETF that we've been intrigued by. Take it away, Connor.
Yep. Well, so primarily my topic for today is the stage 1 base. And if you guys have been watching the videos for some time, we're big fans of that setup and we talk about it a lot. So I thought it'd be a great week to go over some ones that we've highlighted in previous podcasts and then other ones that are setting up right now. And so basically, in essence, a stage 1 base breakout is when a stock goes through a long period of sideways price action, and that's just characterized by a super long, frustrating range. So, looks like it's going to break down at the low end of the range, then it gets bought up, then it looks like it's going to break out, and then it comes back in, and just generally a lot of frustration inside the base. And typically during these times, there's a lot of bad news flow. Everyone kind of gives up on the stock and it kind of goes below everyone's radar. And so Don has Dutch Bros up right now. And if you go to the weekly, this is a picture perfect example of a stage 1 base. And One thing I want to highlight with this one is I think what makes it even better is when you get a stage one base breakout that's fueled by on earnings. And that's exactly what Dutch Bros did. And this is a holding in Grotection, so this isn't hindsight heroes either. But basically, this had everything in that stage one base. Looked like it tried to break out multiple times, failed. And I remember in this space, there was a couple offerings. There was just a lot of bad news. Like, people are thinking like Starbucks is going to eat bros lunch and whatnot. But as that bad news started to come in, price started to build higher lows. And when you start to see negative news, but price doesn't go down further, that's usually a good sign that it's starting to bottom out. And then where Don's pointing right now, that was the earnings gap that gapped it out of the range on huge volume. And to us, that was the signal, the go signal. And especially with these, is your risk can be super tight, because if it falls back into the range, then that's price telling you it's not ready. But the earnings, was showing that this business was turning around. And after that earnings gap, it just trickled higher very nicely. And then, today or this week, another monster earnings gap, and this stock is trading at $81 a share. And just not too long ago, it was, at $25, $30 inside of that base. So, and that's another reason why there's no point to anticipate inside the range, because these stocks that are in the stage one bases, they can last for years and years on end. So it's good to set alerts at the high of the range, because once they start to break out, that's typically when something is happening in the underlying business, and then the price actually has momentum to move higher. So that's Dutch Bros. One of my favorite examples of the stage one base plus breaking out on an earnings catalyst. Next one is Robinhood. This is another one, just textbook stage one base action. This one, and another characteristic that I want to mention with stage one bases is typically they come after a large decline. So you can see, obviously, these stocks got inflated in 2020, 2021, and just valuations in the market in general on QE just got super overextended, and all these stocks kind of came down to earth. And not necessarily, doesn't mean they were necessarily bad companies. It's just they got overvalued and the market was going down, and high beta growth stocks get crushed 2 to 3 times the market when it goes down. And this one was just in a long multi-year period of neglect for, about 2 years. And again, very bad news flow. I remember everyone was giving up on Robinhood as they had that payment for order flow issue, and just, very bad sentiment. And then price obviously started to tell you different, started to build higher lows. And this one broke out early of last year through that 14 level. And you can see the stage two move has been fantastic. And another thing to note is that usually the story isn't widely known as the stock starts to come out of a stage one base. Like, for example, with Robinhood, as it was starting to break out, no one knew that they were going to release that Robinhood Legend platform. No one knew that they were going to add new crypto assets to trade on their platform. And so usually price leads, and as price starts to turn back up, that's when you start to get all that positive news flow and catalyst. And Robinhood's another one that gapped up on earnings this week and is continuing higher. And if you think you missed the stock as it comes out of the stage one base, like Robinhood broke out at $15. Now it's $63 a share now. And stage two uptrends always give opportunities. Sometimes they're not the cleanest, setups that you see in the book, but there's always pullbacks along the way. And where Don's that other arrow is, it actually gapped down on a couple earnings ago as well, but that found support at the 50-day moving average and hooked back up pretty quickly. So this is another perfect example. For the sake of time, I'm not going to go over any more, but if you have some free time, you can look at stocks like Rocket Lab. That's another picture perfect stage one base breakout. And in the last year and a half, we've really seen a lot of them. And now I want to talk about some that are setting up in real time right now that I'm seeing. And the first one is Alibaba. And, this one kind of fits the characteristic. This if you go to the weekly, the stock has been neglected for years. It's been a value trap for a long time. It's super cheap stock. They have a lot of cash on the balance sheet, but price action sucked. And this is the first time in a very long time that this has showed signs of life. This is trying to, broke out through that 100 level, and it's taking out those left side highs, and it's got huge volume. The Hang Seng Index is also tracking its highest weekly volume ever this week as well. So there's money flowing in here, and sentiment for Chinese stocks are horrible. But, like we say, diversification, like you don't want to be in emerging markets when they're going down. But now when you look at BABA, you look at some of these other ones, you have the dollar coming down. Maybe the market's telling you that, hey, maybe some emerging markets might start to work. And in my eyes, BABA is definitely trying to break out of a stage one base. And if this one can stay above the range and continue higher, that will put it into stage two, and it could have some nice upside into this year. So keep an eye out on that one. And then CFLT is the other one. We bought this one this week as well, and this one fits the bill of gapping out of the stage one base on earnings. Relatively decent earnings report, and just coming out of a huge base with volume. So as long as this one can hold above those left side highs, to me this looks like a clear stage one base breakout. And as we've seen in the past, these can lead to very big and strong moves. So keeping this one on our radar as well. And yeah, basically to summarize, stage one bases can lead to big moves, and you don't get paid to anticipate inside the range. So wait for the breakout. If you miss the breakout, there's always opportunities during the stage two uptrend.
Awesome. Great job, Connor. Let's go on to Ted. He's got a couple of other gaps that we're going to talk about, including two that are in the finance industry. Take it away, Ted.
Yep. So every year, normal people look forward to Christmas and the holidays. For us traders and portfolio managers, we get that 4 times a year, and that is earnings season. It's a great time because we're constantly every morning and night searching for the next gappers that lead to these big moves that Connor shared. So I won't go in depth on stage one bases, stage analysis, and stage two uptrends, but I will talk about some fundamental characteristics we look for in these gappers, and often the best ones that lead to the biggest moves. The first one is AFRM. As you guys may know, you guys might have even used their service. It's the buy now, pay later, where you can pay in installments. Definitely helps people who don't have too much discretionary income buy bigger products and just pay them back over time. Of course, you can worry about the debts, but we won't get into that. Why AFRM is so powerful is because it's had multiple quarters of negative earnings growth, or negative, not earnings growth, sorry, negative EPS. Don, if you could point those out on the bottom panel. And this was really the first quarter materialistically where they saw profitability. They reported 23 cents versus negative 54 cents expected. And that's just a monster beat. They also raised guidance, and this also marked triple digits, 143% year-over-year growth. Also really strong revenue growth at 47% as well. And this triggered a gap up into new 52-week highs. And so far, we're seeing perfect price action right now with AFRM. We had a day two higher high, slight pullback to the top of the base, and now we're following through so far. The second name, Upstart, similar scenario. Price action is a bit weaker after the last couple days, but same thing. This is one of those 2020, 2021 IPO stocks that came out at extremely high valuations, as Connor talked about in his segment, and had a huge decline, 80%, 90% plus decline for the last 2 years, formed the stage one base. But again, like Connor said, these companies aren't crap companies, and they continue to grow their businesses, grow their earnings and revenues. And same with Upstart, they achieved profitability this quarter, reporting 26 cents versus negative 11 cents on 336% year-over-year growth. So that's a huge surprise in earnings, huge surprise to the markets. Initially, it acted really well, but yesterday it completely reversed its move so far, And then they also had a mixed shelf offering today as well. I believe they did this last quarter too. So it seems like Upstart, at least their management, isn't too friendly with these earnings gaps. They see it as an opportunity to raise more money, and it just leads to a lot of chop so far. But both these are fintech companies turning the corner into profitability, and it'll be really key to see if they continue this momentum going forward into the future quarters as well. And so the third name I want to talk about, I also want to loop in the S&P 500 and the NASDAQ as well. I call this my quintessential setup, which is a multi-month base with really clear VCP or volatility contraction characteristics. I've discussed that pattern before previously on the show. So let's start off first with FNGS. You can see it's pretty much what the VCP is, just as a review. It's tightening from the left side of the base to the right side. On the left side, you inherently will have more volatility because you just had a big move. So you have those profit takers from lower in the move. So you can see on FNGS, you had that 60 peak to the 55-60 trough. That's the first contraction. And Don, you can draw a diagonal line to kind of highlight that. Perfect. And then next, you have the 60-85 peak to about 57.5-ish trough. And then you had a third contraction, which is so small that you can barely even see it, which is this last little pivot here, which was about 60-36 contraction to 59-ish. And Don, if you can go on a 60-minute chart, you might be able to see that even better. You can just see from the left side of the 60-minute chart to the right side how it just progressively gets tighter and tighter. And now, yesterday, we broke out, and so far it's acting really well. And I'll quickly cover the S&P 500. Don had the 60-minute chart up during his segment, and I want to highlight the fractal nature of this as well. So start off on the daily. I'll quickly discuss the peak to troughs and the contractions again. We have the 6100 level on the left side to about 57.73. That's the first contraction. 6128 to 59.23. That's the second contraction. And to visualize the third contraction better, can you please go on a 60-minute chart? And that's pretty much this 6100 area to 6003, which was the lows on that hot inflation print that Don talked about. And then finally, we'll use the Qs as the NASDAQ proxy. Similar action here on the Qs. Left side peak of about 540 down to 500 trough, first contraction, 533.82 to about 508 contraction. And then you can go on a 60-minute to visualize this last one, 532-ish to about 521 was the final contraction. As you can see, it progressively, once again, more volatile to least volatile. And what that tells us, it's just supply and demand working and human psychology. Strong hands are accumulating from weak hands. It eventually gets to the point where there's no supply left in the markets. So even if there's a little bit of buyers, they'll push the price out, and that's what leads to this breakout. And we can see volume coming in on the breakout. So like Dan talked about, there's fear in the headlines. Don talked about AAI with bearish readings at a 1-year high. But you have the S&P 500, the NASDAQ, FNGS, and all these earnings gappers breaking out. That tells us that the market does want higher, and we will participate because the opportunities are there, and that's what the market is telling us.
And if the market changes, we'll change. It's okay to be wrong. It's not okay to stay wrong. Excellent segment, Ted. Let's go on to Todd. He's going to talk about 2 recent trades.
Okay. I can attest to Ted's enthusiasm for earnings season. You know, in my 30 years in the market, it's been my favorite time. And I learned very early that these gap ups out of bases can be very fruitful and lead to mega uptrends in stocks that have been languishing for a long time. Now, getting back to my examples, 2 weeks ago, I tried my first earnings gap trade in Nextracker. And this is part of the solar area, which really is a group that has been very difficult, and it fits the bill for a sector that's been languishing, and it's not exactly a Trump administration friendly area either, as Trump obviously is very friendly toward fossil fuel. But nonetheless, earnings gaps are often about surprises and catching Wall Street off sides. And on the last earnings gap here, the 29th, Nextracker had what we call a monster earnings gap, and it qualified. Monster earnings gap must be at least 20% up on the day on an increase of volume of over 300%. And it really doesn't matter what the earnings situation is. It's simply a situation where Wall Street was caught off sides. And this qualified from that perspective. It gapped up 24% on 370% increase in volume. And I took a position very close to the close of the day, near the high volume close of 49.24. And it subsequently went higher the next day, which is a good sign. And after 2 days, it held up, and then it backed off. And for 1 day, and traded below that high volume close. Then made its way back up, and this is very common. They will gyrate around. The best ones generally stay very close to their high volume close on the earnings day. But you can see this one got a little volatile, but still was within range. And my stop loss on this was 5% from that high volume close day of 49.24. So that's my mental stop area. And by the sixth day, or the fifth day after earnings, news came out that the Trump administration and Donald Trump signed an executive order to eliminate all permits for solar projects on public land, and I got stopped out for about a 6% loss that day. So these certainly don't all work out. This one started off fine, but it got volatile, and then news from the administration triggered the stop, and that's fine. The second example I would like to discuss is a trade I did last year that was successful, and then going back and analyzing this particular trade, and after taking and studying the gaps more, turned out to be an absolute picture perfect situation. Okay, this one is LRN is Stride. It's a online virtual school education stock. Okay, and basically on October 22nd, you can see the stock had a huge gap. It had previously gone into a few-week period where it was at a 52-week high, but dropped about 26% going into that earnings report. And I'm not sure exactly why it dropped that much, but listen to this report, okay? They came out at 94 cents versus 22 cents estimates. So this was a 327% earnings beat. They absolutely destroyed the earnings estimate. And not only on earnings, their revenues came out at $551 million versus $506 million in estimates. Okay, so right away that's got my attention. I bought the stock in the aftermarket on the 26th or on the 22nd at $76.50. Okay, so I bought it lower than where it had gapped open on the 23rd. Okay, so I already had a good price. By the morning, I was already up on that particular position. Okay, now after the first day, the stock closed up 39.1%. That's a massive gap up. Okay, and a lot of people would be like, there's no way I'm going to buy that stock up this much. Okay, it was a 660% increase in volume on that day, which is massive. Okay, now keep in mind, for a monster gap, we only need a 300%. And this was a 660% increase in volume. And the third major positive indicator of this particular gap, it closed 98% within its range. So it almost went out at the highs of the day. Okay. Now, throughout the following trading days, the next day it undercut the high volume close day by 2%, which is very much average of your best performing gaps. Okay. Now, from there, it basically rode its 8-day EMA all the way through till it hit its first high of 112.50. Okay. Now, what did I do with this stock? I bought it on 10/22 at 76.50, and I sold it on 11/22, exactly 1 month later, at 102.70. Okay. I made 34% on this trade. Now, I thought that was pretty good. It was definitely a trade that I just didn't have a lot of feel for it. It wasn't in a sexy group. Okay. I was second guessing whether it had more left in it or not. But knowing after studying these gaps over the last couple months, if I knew back then what I knew now, this stock never gave me a reason to sell it. Okay. After it peaked at 112.50, it went on to basically go into a 10% flat base between December and the end of January. And it had its second major earnings gap here recently. And what you'll find with a lot of the best monster gap ups, they'll go on for at least 2 more quarters and report and gap higher. And this certainly did exactly that. It had another gap of, it wasn't quite as big. It was only 5.99%, but you can see it's continued to go up, and it's produced a Ryan Ants symbol here where it's just a very strong indication. So really, had I gone back and did this trade today, I would have at least kept half of my position. Perhaps I would have sold half of it or a quarter of it, but this stock to this day has not really given any reason to sell yet. And that's the power of these earnings gaps. And right now, you know, I'd be up over 85% or 98% on this trade had I held it. Now, hindsight's 2020, but this is probably one of the more perfect examples of a stock that rode its 8-day EMA through the initial run, came down, only really closed 3 days below its 21 EMA, but by the next day quickly recovered and just tightened up during that whole process where it got quiet. And then it went on to move, and it had another gap. So really, I would have had absolutely no reason to sell this stock, and I could still be in it. But I took the 34% profit and thought it was a good thing, but there was a lot more on this. And according to the studies, this could easily have 1 or 2 or 3 more very solid earnings reports. So this highlights, 2 examples, one that didn't work and one that worked very well and is continuing to work. And that's why we love these plays. And that's all I have. Thank you.
Thanks, Todd. And folks, I want you to look at that. Todd is actually sharing his research and pulling back his thoughts, and he's showing you where he thinks he made an error. He made good money on that stock, but he could have made more. And he felt like he didn't manage a trade right. And we pull back the curtain and we show you our rules, and we show you how we're modifying and improving them and how we're improving on them. Okay. But he participated in that. And that's how you learn and grow in this. But here's the main thing. At Revere, if we're unsure, we'd always rather get stuck out wishing we were in than in wishing we were out. Because there's too many times it's way too easy to make money that you don't have to try to squeeze out a few extra gains when it's a higher risk. Now, in this situation, he was thinking, I got nice gains I need to protect. I'm not sure. And so he actually took a more conservative approach and booked his profits instead of letting a piece or some of it run. Okay. We're constantly sharing that with you. And that's why you can sign up for our newsletter. Don, do you have anything more before I close?
No, that was I think this is one of our really better shows. That was 3 great segments. A lot of nuances going on in the indexes, a little bit of explanation on sentiment, and
Oh, fire hose.
I
This
hope
is
more.
drinking. Yeah, this is drinking out of a fire hose, folks. Look, here's what I'm telling you, folks. Before the market even opens, Don and I have a one-on-one phone call for about 5 minutes, go over the day review. And then we have a call with the whole team, and they go over every single position they have in the portfolio, everything they're bird dogging, their 3 favorite stock ideas, both long and short, and then their one sector best idea, long and short. And then we go around the room. So everybody knows everybody else's stops, what they're doing, and if Ted misses a stop, or God, Don forbid, of course he doesn't, and it's not getting sold, Don will tap him on the shoulder. Hey, Ted, Connor, that thing hit your stop. Now that hasn't happened yet, but it can, or it might have happened once. You can ask Don. All I'm saying is it's steel on steel here, and we're constantly working and improving. But when the market's, we've already had a meeting an hour before the market's open going over our whole day and what we're going to do. And when the market's open, there's always at least a few people sitting there in the pit watching your portfolios. We're not on the back 9. Let me repeat that. We're not on the back 9. We don't play golf, at least when the market's open. Folks, we're managing your money like we manage our money. If you want your money to look like our money, not Wall Street's lie charts, come join the Revere family. Listen, if you like what you heard, please tell a friend, tell a neighbor. Just go up to the right-hand corner where there's a subscribe button. You can just put your email and your name in there, and you'll get our daily market insight video every night the market is open, and you'll get this podcast on Saturday morning as soon as Zach puts it. Well, it goes in our email or our newsletter delivery. However, if you go to YouTube and just search for just Revere Asset and hit subscribe, Zach will have our producer have this thing out by, say, 12:30, 1 o'clock Central Time, and our stock nerds get this a couple hours before the market closes. So there's 2 different ways to get our stuff. And next to that, there's a contact us button. You can send me an email, ask me for a complimentary portfolio review or a stock or a topic you want discussed on the show so we can show you what we would do with your money. Folks, don't get a lie chart. A pie charts are us from a stripmalladvisor.com. Learn a better way at Revere. We'll talk to you next week on your money, not their money, your money.
So it's not how much you make in the markets, it's how much you can keep.